quickly, we were chatting behind stage too about the potential for the SEC and the bank regulators to fight amongst themselves over which one has jurisdiction over stablecoins.
Won't be the first time they squabble. So yeah.
Right.
Members of the audience that remember the Washington response to the first wave of the internet was a bipartisan, very timely response, and very forward-leaning. And that response was known as first, do no harm. That was the Clinton White House and the Newt Gingrich Congress came together that said the first wave of the internet should not be strangled at birth by just an inappropriate regulatory response. What a contrast 25 years later to the response we're now seeing in Washington, which is not at all first, do no harm. It seems to be first protect the incumbents,
right.
First protect the status quo, and first protect the regulatory state. I mean, there's no indication coming out of that I can see that the regulators themselves have any obligation to innovate and to be forward-leaning on this. It seems to be as harsh as one can expect. That harshness is all directed toward protecting the status quo of the financial system, protecting the status quo of incumbent players, protecting the status quo of the exclusiveness, the slowness, the latency of the existing system. It's really quite a disappointing for one who lived through that earlier phase of the internet, knowing how much our financial system needs to be modernized, and yet this response is just preserve it at all costs.
Well, I'd love to dig into stablecoins. There's been a lot of talk about stablecoins in Washington and other policy centers of power around the world. So the President's Working Group just released, just a couple weeks ago, its report on stablecoins with its policy recommendations. While we were talking about Crypto Mom, she spoke at an event in Texas, I don't know, maybe a month or so ago, and I heard her talk, and she had stated that she believed that a lot of these efforts and the focus around stablecoins was a way for the government to try to capture DeFi or stifle the growth of what's happening in decentralized finance. I'd love to get your thoughts on ultimately what do you think are the drivers in terms of this focus on stablecoins. And then I also just wanted to highlight one part of the concerns, which is that these may pose systemic risk to the financial system. I mean, we've looked at that, and the stablecoin marketplace has grown at really incredible rates, especially just in the past year. It's really amazing to see how much this market has grown and matured. And the argument is that, well, if it keeps growing at these huge rates, maybe they'll become systemic. So I also wanted to kind of pose that to the panel as well on, do we feel like this could pose systemic risk to the financial system, because stable coins and other activities that have already been systemic are not apples and apples. Like, these things look incredibly different. So how do we make those leaps logically?
Yeah, well, the good thing is so far, the Fed has said that it's not systemically important. So, I'll take that to the bank, so to speak, right now. But, things could change. The SEC, of course, is looking at stable coins as being equivalent to money market mutual funds, and the President's Working Group.
Because the national bank regulator, the OCC, has essentially made it clear that it's not going to be approving crypto-related activities or crypto-related applicants. And some of the applicants that are crypto native that applied for OCC trust bank charters have quietly been asked to withdraw those, and it's now public that that has happened. So in the banking world, the states they're not going to be subject to some of the restrictions that the OCC has decided to put on itself. And so the action will be in the states, not at the federal level. And the other interesting thing about the banks with state regulators is they work together to push back against federalization. In the securities world, it's clear that federal law preempts the states because of the Supreme Court decision on Howey, the famous Howey test. That federalized what previously had been state law. That is a Supreme Court decision, very unlikely to be overturned. But in banking and money transmission, that's regulated by the states. There is a federal version in the national bank regulator, the Office of the Comptroller of the Currency, but 85% of the banks in the United States are actually state regulated, and some of the largest ones, like State Street or Goldman's Marcus Bank, those are state regulated banks. And what's fascinating is the states have, typically the state bank regulators have economic development in their remit. And so they do tend to push the envelope more than the federal regulators do. The federal regulators do not have economic development in their remit, and so they tend to be more cautious. And so the action is going to be in the states. And it could not be more crystal clear based on the statements from the OCC itself in the last couple of weeks, clarifying that they were going to be turning down a lot of the crypto applicants for national trust bank charters, and also that the so-called examiner in charge has to give prior written approval to banks who are going to get active in crypto. At the time when I saw that, those of us who are deep into the banking law world thought, oh no, what's likely to happen if you read the OCC's pronouncements is that there's going to be a wave of debanking of this industry in the next year as the policies that the three federal bank regulators have decided to implement, the Fed, the FDIC, and the OCC. That is, when they get together and agree on a policy, they have the tool without having to go through Congress or without having to go through a public comment period to implement that policy. And the tool is the way that they rate the management of the banks. And so they will be, as they go through the bank exams in the upcoming 12 months, they will be putting pressure, if you believe their speeches, which we have no reason not to, they will be putting pressure on the banks that bank this industry, and indeed, the banks that bank fintech generally. Go read the OCC Acting Commissioner Su's speech, where he is going after bank as a service and rent-a-charter models, and essentially saying all the fintechs now need to go get bank charters as well. Do not be shocked. I think the expectation should be that there's going to be a wave of debanking, not just in crypto, but also in fintech in the coming 12 months.
Yeah, and when you say crypto, you mean all types of crypto type companies, not just stable coins.
Right.
Well, one thing too, I mean, just one bright spot here potentially. I mean, they will try to do this. We saw this back in the Obama administration when the FDIC did their what they called Operation Choke Point, which I think is illegal. But anyway, they basically there were disfavored industries, payday lenders, gun shops, gun manufacturers, where the FDIC said, to go into a bank saying, you have a nice bank here, wouldn't it be a shame if something happened to it? So like the mafia does. But anyway, so saying that if you are going to jeopardize the reputation of your bank by banking one of these disfavored industries, then we may have to do something kind of nasty to you, like, raise your insurance rates or shut you down. Or
prevent you from engaging in mergers, prevent you from getting into non-bank activities through a sister company, and changing what's called your cap rating at the Fed. There are 4 things that they do when they rate a bank down lower in what's called the M of their CAMEL score. So they have the power, they absolutely have the power to enforce this policy.
But the good thing is, I think, is that things have changed now in 4 more years. So just the growth of the alternative payments industry through crypto assets, and not just here in the US, but internationally. At my firm, we've been working on alternatives for folks, potentially for alternative payment systems, alternative platforms, if things go from bad to worse in some of this stuff. So I think there is a lot of potential. I mean, the feds have a lot of tools in their arsenal, but again, when you look at the federalism aspects of the United States governance system, I think there are a lot of tools that will be helpful in the future.
Our industry's chief supporter on the Hill, Senator Lummis, is quarterbacking that, and so stay tuned. I think the exposure draft will be coming out before the Christmas break, so it'll probably be within the next couple of weeks. And folks will get a chance to comment on that. And it does propose fixing a lot of these issues because it's pretty obvious where the fault lines are. And it's pretty comprehensive. And she has made some public comments about this, but I think you'll see it released for comment where everybody can comment on it relatively quickly. I'm more optimistic than normal about possibly getting that through Congress because there is bipartisan support for it. And we've seen some strange bedfellows coming out of Congress. You saw Senator Lummis, who's a more libertarian-leaning Republican, team up with a progressive Democrat, Ron Wyden, to fight the infrastructure bill definition of broker. That was an alliance nobody saw coming. I don't think they'd probably agree on very much.
Didn't even see it coming.
Probably not, right? But you're, and then you really are. Let's put it this way: every single elected representative in the United States has constituents who own crypto, and we've proven that when we care to get involved in something, we actually can have a pretty big impact.
Actually, Perianne, I predict that 2022 is we're going to see both the worst and the best out of the Washington Beltway vis-a-vis crypto this coming year. I think we're going to see some of the worst of regulation by enforcement out of some of the market regulators. I think out of some of the prudential bank regulators, you're going to see some of the most restrictive and unhelpful moves. But at the same time, it's an election year. Every member of Congress has got to raise on average of $50,000 a day between now and next November to get reelected. And part of that raising that money is going to be listening to voices that are going to come in for this new industry and say, look, I'm happy to support you, but here's what we need. And so I don't think you're going to see legislation moving this year because it's such an important election year. But I think you're going to see a lot of promises made by people running for reelection in order to accept support from this industry. And I think 2023 is going to be the year where those chits are pulled in. And I think 2023 will be the year where Congress might seriously take this up because of the influence, the growing influence that this industry is having on Congress. I mean, that is the way our system works. Whether we like it or not, that's the way our system works. I think 2023 is the year that this industry is going to go to Congress and say, okay, we support you. Now we want to see some action on this. So I think in some ways this is going to be a tough year. And the goal in this industry, I think the goal for players right now is to survive, to get to the other side. But I think there's hope on the other side because I think, and I saw it in Wednesday's hearing before the House Financial Services Committee, you can tell the light bulb is starting to go off for members of Congress. And what it takes to turn that light bulb going off into legislation is still quite a bit. But I think that there's light at the end of the tunnel, and we'll see it when we get through this year.